Right, well, if we're ready, good. Hello, everyone, and welcome to another episode of Taking Stock After the Bell, episode 29. Delighted to be joined today by Tom Slater, the manager of Scottish Mortgage Investment Trust, along with Claire Shaw, the portfolio director. So good afternoon to you both, and welcome.
Thanks for having us. Yeah,
just run through their biographies as per normal, and then we'll kind of get cracking. But Tom is the manager of Scottish Mortgage. He joined Baillie Gifford in 2000, became a partner in 2012. Tom joined the Scottish Mortgage team as deputy manager in 2009 before assuming the role of manager in 2015. Beyond that, he is head of the US equities team and a member of another long-term growth equity strategy. During his time at Baillie Gifford, Tom has also worked in the developed Asia and UK equities team. Tom graduated with a BSc in computer science with maths from the University of Edinburgh in 2000. And Claire Shaw is portfolio director and plays a prominent role in servicing Scottish Mortgage's UK shareholder base. Before joining in 2019, she spent over a decade as a fund manager with a focus on managing European equity portfolios for a global client base. So good, welcome to you both, and thank you for joining us. So the question we kind of like to ask when we sort of kick off, and James and I talk quite a lot about this, is how you feel that your own personal investment philosophy has been shaped by your kind of background when you started in the business, where you started, and your sort of formative experiences. Because I always sort of, there's always stories about the generation that grew up in the aftermath of the Great Depression, for instance, never wanting to touch an equity. And it was noteworthy that your career at Baillie Gifford started in 2000 at the peak of the dot-com bubble. So has that sort of shaped your philosophy and views about investing at all, do you think, Tom?
Well, I think what's been useful about that is after 10 years of rising markets and growth doing really well, there's been a more difficult environment for growth over the past 2 or 3 years. And if you started in the last 10 years in this business, then that's quite a big shock.
Definitely.
But whether it was that period through the first 3 years of my career, whether it was 2008 and 7-8 and the financial crisis, actually those experiences are quite both how you feel and the emotions that you have to contend with in the face of that environment, but also the knowledge that these periods come to an end, and actually focusing on the core task, not being distracted, not being tempted to, particularly for us, tempted towards safety to secure companies. I think that's really important. And I'd say the other experience which really informs the way I manage money is it's just seeing the impact of a small number of exceptional companies that if you look over that 24 years, you can probably count on both hands the number of stocks that have really made a difference to performance over that time. And so that really informs the way that we structure the portfolio, the concentration, the willingness to run winners.
Winners. Yeah, no, that's interesting. And then, do you want to give us a sort of little bit of a potted history of Scottish Mortgage? I know it's been around a while, but do you want to sort of just give a little bit of background for the viewers and listeners as to the fund that you run?
Yeah, of course. So we are we have a portfolio of about 14 billion sterling, which is about today about 74% in listed companies and 26% in private companies. The objective is to be long-term owners of the world's greatest growth companies, wherever in the world they are, however they're structured. And where we find those companies to be really long-term and patient. In a world where people's time horizons are shortening, where the average holding in mutual funds is measured in months, we are resolutely long-term and patient. I think it's only over those sort of timeframes that you know the competitive advantages of companies, the brilliance of management teams can really play out in the results.
Good. And is that hasn't always been the way the trust has been run, has it? When did that sort of? I know it's obviously always been a long-term investment portfolio, but that focus on sort of the real growth stocks. When did your sort of change in philosophy happen? Was that driven by you or you and James? Or be interesting to hear that.
Yeah, I mean it's always been long-term and it's always been growth-oriented. But I think Warren Buffett used to say that the institutional investor was an oxymoron. It was a bit like Lady Mud Wrestler. That but this idea that you could institutionalize an investment process, that it is always necessarily has a personal component to it. And so if you look at whether certainly in my investing career, when it was Max Ward that was managing it up until 2000, James who took over at that point, who then I joined in 2009. I think there's been an evolution. If you go back to the late 90s, I think a lot of the infrastructure of the pension fund industry at that time was evident in Scottish Mortgage. It looked at weightings, relative to indices. It thought about tracking error. It thought about regional allocation, and with the help of the board, who've really pushed us in on this. First under Donald Mackay, going right back to that sort of 2000, to really focus on what at that point we were one of 6 or 8 large global generalist trusts. We really examined, well, what is it we're actually trying to do for people? Why do we deserve a role in people's portfolio? What's unique about what we do? And that really set us on a journey. We reduced the number of stocks significantly. It was probably 200 at that point. It's less than 100 today. We had a half UK, half international benchmark. It's now managed against a global benchmark. It was all listed. It's now a mixture of private and public. So I think it's been that sort of continual evolution and saying, right, the role we do for our shareholders is that we're going to pursue long-term capital growth, and in doing that, we're going to accept that volatility is an inevitable consequence, and we're not going to worry about that. That are one of our points of uniqueness is being patient in an impatient world. And we don't expect that we'll make up 100% of any of our shareholders' portfolio, but we believe that everybody should have some Scottish Mortgage somewhere in their portfolio.
I guess it's just so unique that you couldn't go out there and raise 14 billion today and put it into the mixture of investments you have. It's been
the history is definitely part of the story.
It's such a huge amount of work to get it to where it is today, to have this unique opportunity to invest the way you do. It can't be replicated.
And I think it's we have that heritage, and the incredible efforts of some of the Baillie Gifford partners who've managed the fund over the past 100 years. But it's also saying, right, how do you take that and actually turn it into a competitive advantage, enable you to do something different? And so one example of that is the holdings to fast-growing private companies. If as a private investor, it's very hard to get access to these companies. They certainly the most promising ones choose their shareholders. Even if you find a vehicle that you can get access to them in, it's going to be illiquid and it's going to have very high fees. And the way that we can use Scottish Mortgage's structure is we have permanent capital base. We can, because we're seen as long-term responsible owners, we can get access to these companies, and we use our scale to do it within our existing fee structure. And then we're liquid. So and that's what 100 years of being traded on the stock market gives you. It's a liquid way of accessing these really difficult to access and completely illiquid assets. And I think a lot of the fund management industry has been trying to figure that one out. But it turns out this 100-year-old vehicle is the best way to do that.
Yeah, and that's really interesting. And we'll come on and talk about some of the private assets that you've got and how that's kind of developed over the years. But we've got listeners will be pleased to know we've only got one chart today, so they won't need to be scratching their head as to what we are. We've got a 20-year chart of Scottish Mortgage, total return terms. I was chided for putting up a 10-year chart, so I changed it. And on an indexed basis, 20 years, it's gone from £100 effectively to just shy of £20. So, to 100 to 2,000, or 10 to 200, a 20 bagger essentially in 20 years. And I put it on a log chart because it looks a bit silly on a linear chart, because that sort of highlights, you mentioned, the exceptional returns, but also the volatility along the way. And, what is noticeable to anyone was that there have been a couple of 50% plus declines during that period, which is, back to your point about should investors have 100% of their assets in Scottish Mortgage, you need a pretty strong resolve.
Only the managers.
The managers. Maybe Baby Raymond could have 100% of his portfolio in it, but that's by the by. But it has been a pretty kind of incredible long-term track record and long-term story, and you mentioned a kind of a few of those small handful of companies that have driven a lot of those returns. Should we start in sort of terms of some of those companies, a stock that's a little bit in the news, was always in the news to be fair, and had results last night, and Tesla, and that's been in the portfolio for 10, 11, 12 years?
Bought it in 2013.
Yeah. 2013, yeah. And that's been on its own kind of journey, but obviously a very profitable journey over 10 years, but over 3 years, but somewhat more kind of checkered past. What's the sort of the thesis there, and what do you like about Tesla, and how do you see that kind of developing?
I think Tesla exemplifies that culture of real ambition, really pursuing difficult and challenging long-term opportunities, accepting that it won't always succeed, but that the payoffs from doing so can be really big, and also that you can have a real positive impact on the world. Some investors take the approach of, we want to find big, established, safe companies with wide moats that can, harvest their position in the industry and grow steadily with high margins over time. And that's fine. That's a perfectly valid way to invest. But what we're looking for is companies with the ambition and drive to go after things that aren't easy. And one consequence of that is volatility. We talked about Scottish Mortgage share price. The Tesla share price. It's over the long run, it's been really pretty successful. But it's you've had at least 10 periods in the time that we've owned it that you've had drawdowns of more than 30%. Yeah. And that, by the way, is a characteristic of all of our most successful investments. Yeah. Nvidia is really topical. It's done really well. Aren't we clever? Well, we bought it in 2016. The biggest peak to trough drawdown in Nvidia since we owned it is 73%. So having that resilience in the face of looking quite stupid is a really important quality. But getting on to Tesla today, I believe Tesla is once again being misunderstood in a way that we've seen in past evolutions. Starting point for people is EV demand, electric vehicle demand is weak. I don't think electric vehicle demand is weak. I think demand for high ticket items is weak. Right. Given what's happened to interest rates. Yeah. And then I think if you're going to successfully sell an electric vehicle, you have to have a product which is really appealing to some subset of the market. You have to sell that product for a really compelling price, and you have to have a brand story, or you have to create the enthusiasm and have an authentic brand story to engage consumers. And I think the whole of the rest of the automotive industry has failed to meet at least one of those three criteria, and that's why they aren't selling any EVs. The Tesla Model Y was the biggest selling vehicle in the world last year, and that's for a vehicle that has a $50,000 plus price point. That's never happened before. That doesn't suggest weak demand for EVs. So I think the story in vehicles, has more to play out. It has some challenges in the short run with the lack of new model introductions. I wouldn't deny that at all. But I think the piece the market is missing is that automotive is this selling traditional vehicles is just a small part of the Tesla story.
Right.
Tesla is an AI company. They've made huge leaps forward with their autonomous driving system. We can dig into that if you want to, but I think that's ready for prime time. I think you are moving to a world where these cars drive themselves. You can think about fleet ownership. You can think about robo taxis. And you can think about high margin subscription software.
Right. Yeah. Is the self-driving capability, is that available in the UK now, or where are we in the sort of adoption of advanced driver, or whatever you want to call it, full self-driving?
Not available in the UK, only in the US.
Right.
I think that reflects a very challenging regulatory environment in Europe. But if you look at that system in the US, we've seen iterations, we've seen improvements, but what's really unleashed it is actually getting rid of the human programmers altogether.
Okay.
Nobody programs nobody writes software for those vehicles now saying, in the US case, drive on the right hand side of the road, stop at stop signs. The system ingests loads of video, pixels in, controls for the car out. It does that on billions and billions of pounds of hardware that Tesla has invested in.
Yeah.
No one else anywhere in the world is close to that type of capability today.
That's interesting.
And what about the sort of Elon Musk risk in terms of, he's talked about trying to get voting, his percentage of voting shares back and potentially changing jurisdictions if that doesn't happen? It's obviously something you have to be aware of or think about, worry about. But how do you sort of analyse that?
I think Elon Musk has added a huge amount of value for Tesla shareholders. We were supportive of his package in 2018. I think I would be supportive of that if and when it comes to a shareholder vote again. I think where what does the replacement for that package look like? What's the next leg? I think that's much more nuanced. Increasing voting control beyond economic interest, particularly when he's been a seller of shares in recent years, I think is more challenging to accept as a minority shareholder.
And Scottish Mortgage owns 1% or so of Tesla.
I don't know the number off the top of my head.
It's not an insignificant quantum of the company, though, is it? It's on the register, certainly.
Yeah, we've been large and long-term owners, and I would also stress that I think the level of engagement from Tesla and the Tesla board has been really strong. They do engage with their long-term shareholders. There is transparency. The chairwoman makes herself available on a regular basis. So, I think from that standpoint, they've actually done a pretty good job.
Good. And staying on the sort of electrification theme, Claire, do you want to sort of talk about kind of Northvolt and the position, the portfolio, and what you've got there and the sort of the drivers behind that?
Yeah, sure. So one of the areas that we are excited about in Scottish Mortgage is the energy transition. Not only the electrification of the ground, we have players that are electrifying the skies as well. We can maybe come on to them. But
Definitely.
When you look at electric vehicles and you look at that kind of value chain, we have Tesla, obviously manufacturing, but then you kind of got the value chain and you look at companies like Northvolt that are making the batteries for these electric vehicles. And Northvolt is a Swedish player. And they're in a really interesting position in that if you look at the global supply chain right now, about 80% of all batteries for electric vehicles come from Asia.
Mm-hmm.
And for the European automakers, in an increasingly uncertain geopolitical world, they really want to have that more localized domestic supply. So they're able to execute on their plans as well. So you see Northvolt right now with something like a $55 billion order backlog for demand for their EVs from players such as Volkswagen, Scania, Volvo. And that really shows you not only the strength of demand, but also Northvolt is a unique company. There's no other company right now that is being able to provide that scale that Northvolt can.
And do they have decent margins on that? I mean, is it a sort of commoditized type business? Warren Buffett's moats thing, or?
Yeah, so Northvolt right now is in that kind of ramp up position. They've got a factory in northern Sweden. They have announced in the last couple of years they are building another factory in Quebec in Canada. Okay. They are announced a plan in Germany as well. So right now Northvolt is in a position of really trying to ramp up that kind of manufacturing to kind of meet that demand is the kind of when they are in that kind of maturity curve at the moment. So they've got that order backlog, which gives them the confidence.
Great stuff. And staying on the private stuff, so 26% of the portfolio are in non-listed private companies, as you said. I do want to talk about the space exploration names and what your sort of thoughts are there, and if you want to sort of walk us through what you've got in that space, that'd be, I think, really interesting.
Yeah, sure. So as you say, we've got about 26% in private companies at the moment. And maybe just coming back to something that Tom said earlier about, why do we do this? Why are we investing in private companies? And I think that it's important to say that if you're trying to find the most exceptional growth companies in the world, you need to have the broadest opportunity set. And with companies staying private for longer, you need to have access to those private companies to have that access like we talked about. But as you say, SpaceX is our largest position in the trust at the moment. It's just about 3.5%, and it's a really
largest private position.
Largest private position. Sorry, sorry, well corrected there. And it's one of those companies that there is no public market equivalent of SpaceX. It is a very, very unique asset. What they are doing not only in the launch market is incredible. They pretty much have a monopoly there. I think last year they did something like 96 launches, which gives them in the region of about 80% market share of that launch market. So they've gone from a position, of having no market share to 80% market share in a very relatively short period of time, which is pretty phenomenal. But in addition to the launch market, they've also got Starlink, which is their satellite constellation business.
I see. Satellite broadband.
This is I guess building the internet in outer space, if you want to call it. And it's a really interesting business. This is a business that now has over 2 million subscribers. They're trying to, I guess, end mobile dead zones in parts of the world. Even the US, for example, has 20% of the US is not covered by broadband, which seems incredible. But Starlink are able to sort of bring that broadband coverage to parts of the world that don't have it.
They've been quite instrumental in Ukraine, is that right?
They have
brought broadband to large parts to help with the war effort, I think, is that?
Yeah, I mean they did Musk did offer Starlink to Ukraine, but I think from his perspective that was not really the intention of Starlink, is to be mobilized in conflict situations, and I think he's actually taken steps to try and put that in a separate part of the business. But I think from a Starlink perspective, this is a huge market. The broadband market is $1 trillion market. If they take a small percentage of that, it's a huge amount of revenues.
And with kind of hybrid working and people being more mobile, we all want kind of fast and reliable broadband, and we're actually more than willing to pay for it in the main, aren't we? We just had fibre installed at home, so that sounds interesting. And in terms of the kind of private assets, at 26% of the portfolio, where does the idea generation come from? Where do you get people knocking on the door to you in Edinburgh, walk down the street and say, we've got this great idea, do you want to come and invest with us? Or is it sort of network effects, or is it that kind of history, or where does it sort of come from?
I think it predominantly comes from I'm hesitant to say reputation, and I would describe it more accurately as how you behave.
Okay.
People can see that we've been one of Amazon's largest shareholders for 20 years.
Mm-hmm.
They can see we've been a supportive, engaged owner of Tesla for more than 10 years. How you act matters. And so translating that into the private companies, they when they reach the sort of scale that we're interested in, we're not interested in startups, we're not venture capitalists. When they start to achieve scale and they're thinking about the future of their company, is it going to be independent? Are they going to transition to public markets? They're looking for owners who can be with them on that journey.
Yeah.
Owners that they want to stay with them as a public company. And so I think that's a really important part of getting access for us. I think the next part is that actually, our best advocates are the people that run the companies we own. And so we get a lot of introductions through some of those networks.
Sure.
And then the other piece is, we Baillie Gifford have been investing in that private capability, quite rapidly over the past 10 years. There's a dedicated team of analysts who work out searching for ideas.
Okay.
And managing some of those relationships.
Good, that's interesting. And is there plenty of opportunities in the pipeline, and plenty live, or is it sort of quietened down a little bit in the last year, 18 months? Do you think?
Well, we've been close to our 30% limit in privates for some time, and as a result, we focused on being there to support our existing holdings when they're doing additional rounds. So whether that's Redwood or Databricks or Stripe, as examples of that in the past 18 months. But that hasn't really been a constraint for us, because there's been very little confidence in private in private investors and private companies. They've seen what happened in public markets. They know that the capital supply has decreased substantially. So where companies have had to raise money, they've generally just done insider rounds, generally not priced rounds. Right. They might be debt instruments with conversion rights. And so we've been there. We've been able to support the companies we own that have been doing that sort of thing, but we haven't been missing lots of new transactions. As we sit today, I feel like you are starting to see early signs of confidence returning, in public markets and in the private sphere, and so it may well be that we start to see a pickup in activity.
That's interesting. I know we've talked a lot in the last sort of year, 18 months about how the cost of money has gone from 0 to 5%. In a 0% cost of money environment, a lot of sort of startups, growthy business, they had as much funding as they needed, and you get to a 5% cost of funds world, and they've not been able to just hoover up cash, and therefore they've had to almost change tack. But as you sort of alluded to, the downside of that is that we've not had private companies moving into the public market. I mean, the IPO window has essentially been shut for 18 months, isn't it? Which probably doesn't help. So I think it's definitely encouraging to hear that we might be coming to the end of that, and maybe the door is opening for some of these names.
Yeah, I think for us, we have permanent capital. We don't have an agenda on our timeline to push on these companies. But equally, where a company has achieved sufficient scale, where its business is predictable, there are some good rationales for thinking about moving public. And from a narrow Scottish mortgage perspective, seeing that happen frees up capacity for us in that part of the portfolio. We can do privates to think about deploying into new companies.
But presumably the other side of that is because you're investing in businesses that they're not startups, they have really good market shares. Actually, because debt isn't free anymore, and PE is probably less likely to say, here's all the money you want, just go and grow and grow and grow and chuck money at everything. Actually, your businesses you're invested in don't almost have that the same competition anymore at trying to disrupt it, and they can grow the moats bigger. They've got, presumably the cash flow, if they need funding, it's there, or they've already done that work over the last few years. So actually the opportunity of your private businesses today might be better than it was beforehand. Is that the case? Or
yeah, I think that definitely is something you can observe. So take a company like GoPuff, which is a instant delivery business. It's it's the type of products you buy in a convenience store, or alcohol, delivered to your door in 20 minutes. That
I'll write that down.
You get the here in 15.
You need to move to the US to get it. But that market was seeing a huge amount of investment. People were going after market share, lots of couponing, doing the very low cost delivery, and actually that's quite an expensive service to execute. It's quite low basket size. You need to price appropriately, and so in back in the heyday of cheap capital, you lots of companies were able to raise money and throw capital at it to try and gain market share.
Sure.
That's gone.
Yeah.
Now that makes it a more challenging environment for GoPuff, but a much more challenging environment for their competition. Most of whom have gone out of business. And so that this is the type of period in which they can build enduring competitive advantages.
Sure. I was actually going to ask about home delivery, because there seems to be a suite of stocks in the portfolio. You've got Ocado, HelloFresh, DoorDash, Delivery Hero. I mean, do the economics of home delivery stack up on a long-term basis? I mean, it doesn't strike me as a particularly high-margin business, and it also strikes me as a kind of very infrastructure asset heavy business. How do you sort of see that developing, and do you see the economics becoming quite attractive there?
Yeah, I think there is just a changing preference amongst consumers for how they consume food. So if you look at let's say more general merchandise e-commerce, you saw a spike up in penetration during COVID, where everybody's trapped in their homes, and then you've fallen back to the established trend line.
Yeah, the ONS have got a fantastic chart on this.
Right,
and
okay.
It's perfect. It goes up in a straight line, and you get this massive COVID bump, and then it comes right back to the trend.
Yeah, exactly. And if you look then at food delivery, you see that didn't happen. You saw a spike up in COVID, and it hasn't gone back to the previous trend line. It's continued to grow from a higher level. And I think that speaks to changing consumer preferences. And now I think that there is some economic pressure in there. And high rates does make a difference. But for the strongest players, that ability to take market share, you get a high level of repeat from customers. Particularly those customers who will pay a monthly fee to get they're a member of the subscription service.
Get the slots. Don't forget your Christmas Ocado slot.
Yeah,
it's worth £4 a month alone.
Yeah, well, that's you build tremendous customer loyalty if you've got to meet the meet customers' expectations on delivery times. You've got to be accurate in what you bring. It's not going to have short sort of out of date pieces on the food. And the other thing to remember, of course, is we're slightly spoiled here in the UK. That actually grocery delivery from supermarkets, it's one of the best penetrated markets in the world.
We're quite a small island, aren't we? And
we are, and
populated,
actually the economics of doing that are easier. But in
definitely.
other parts of the world, it's a more challenging thing to do. The other piece of this, of course, we're talking about these businesses today. We invest in a couple of the companies which are going to completely transform this. So Neuro does delivery vehicles, which are electric, autonomous delivery vehicles. This is a sort of this want to be an easy application of autonomy, because you'll have a defined delivery radius, and one of the challenges with autonomous vehicles is we as passengers get quite frustrated if they're not going quite as fast as we want, or if they're being timid at junctions, or but your pizza delivery doesn't really care about that sort of stuff. So that's one change. But one of our top 10 private holdings is a company called Zipline, and that's much more radical. So they do deliveries with drone aircraft.
Right.
Now, this is national scale infrastructure. In sub-Saharan Africa, there are several countries where they control most of the blood supply in the medical sector. This company's done 1 million drone deliveries to date. And in doing that, there's been all the technical learnings and progress to get this to a price point where you can start to do not just medical deliveries, but more consumer-oriented deliveries. And that they are going to be looking to launch that in the US, in a relatively short time frame. And just think about it from first principles. You order a couple of bags of Chinese food. Maybe it's 3 kilos. You then put that into a vehicle that weighs 1.5 tons. Burns carbon. You put a human that you have to pay in the driving seat, and then it goes through traffic to bring that to you. Versus putting it into a 20 kilo autonomous, electric, clean, sustainable vehicle that can make that journey much faster, can give you a delivery window of more like 60 seconds than 1 hour. It's just a much more efficient way of doing things.
That does sound exciting. And then Claire, sort of another kind of issue in the background is kind of ByteDance, the Chinese owner of TikTok, the owner of TikTok. The US government have sort of suggested that they need to kind of divest of the US business. Do you want to sort of talk us through? I mean, Scottish Mortgage owns a reasonable amount of ByteDance.
Yeah, I mean, I think the first thing to say is the situation is changing almost daily. So with regards to our visibility on the outcome of that is very, very difficult to say in terms of what actually, how that will end up. I think that's the first thing to point out. I think the other thing to point out from a ByteDance perspective is almost separating the operational performance of the company versus the sentiment surrounding the company. ByteDance is a phenomenal business. It's roughly the same size as Meta in terms of number of users and revenue, but it's probably a fraction, maybe a sixth of the size of it in terms of the value of it. And so
TikTok users generally spend a lot more time on TikTok than they do on
in
Facebook,
terms of the engaged
Instagram.
hours. So I think if you want to separate out the two things, you think from our perspective, from an investment standpoint, ByteDance continues to execute phenomenally well on that core business. But the outcome of TikTok and where we end up with that, we just don't know at this moment in time. It's hard to say with any confidence where that ends up.
I think that I think the silver lining in this is, as Claire says, in terms of valuation, this has been a big overhang. It's stopped the company becoming a public company, and at the very least, what's going on in the US political sphere is going to bring this to a head.
And you've got reasonable exposure to kind of Chinese businesses, Chinese technology businesses in particular in the portfolio. Does this sort of quasi-Cold War splintering of the world between West and East, does that sort of worry you at all as a owner of these businesses? Is that something that people need to worry about? We've talked about it in the pod for a number of reasons, mainly around kind of the disinflationary period that we've been through, and maybe that's coming to an end. But from a sort of regulatory perspective, is that something that concerns you?
Yeah, it is. I think it's the chances of a real discontinuity in that relationship is small, but it's increasing. But I think there are two regulatory threats to owning Chinese assets. One is the one that comes from the US, and could they stop Western investors investing in China? And then actually the bigger challenge has come from the Chinese regulators, over the past couple of years, that you've seen continuous interference in the corporate sector and private Chinese companies.
Mm-hmm.
A redefinition of what's acceptable from a Chinese company. And that's actually been far more challenging for us. Whether it's in what happened at Ant Financial, the fintech business, it's the challenges for scale for some of our big online platform companies.
Mm-hmm.
At our peak, we had about a quarter of the portfolio in China. We have about 10% today.
Okay.
We've taken about £1 billion out over the past couple of years.
Mm-hmm.
But we think you can't ignore China. It's the world's second largest economy, the largest economy on some measures, and you've got brilliant entrepreneurs that are able to operate at real scale.
Mm.
So the bar for inclusion in the portfolio for a Chinese company has risen.
Yeah.
But we think for exceptional Chinese companies, you can't ignore them.
Mm. That's good. That's interesting. We're sort of coming to sort of wrap, and we've managed to get through most of this without mentioning artificial intelligence just once. So tell us your sort of thoughts on how you see that developing. Is it going to take my and Hughesy's job, or is it going to help us? And what have you got in the portfolio on in and around that space?
Well, I think the first thing to say is we just don't know. This technology is progressing at an incredible speed, and so the follow-on from that is how long is it going to stay on this trajectory? Because the consequences for the shape of the economy will depend on the answer to that question. What we can say is that with the capability of the systems that you have today and the ones that you can see coming down the pipe, is that it's a general purpose technology which has applicability across the economy.
Lots of sectors, yeah.
And it's going to change the way billions of people work. It's going to change the established structure in lots of industries.
In the same way the internet did, I guess. I mean,
Yeah.
I don't remember 99 particularly well, but 98, 99, but there was a sort of feeling that the internet is going to change, and lots of people were very worried about that change. But if anything, the internet has changed the world of work or the world around us more than we would have anticipated, or even the most forward-thinking people in the mid to late 90s. Is AI in that sort of category of real disruption?
I think the earliest signs are that it is, and if you look at you talk about the internet, and I think it's a really telling example that it's there is a change in the way that we interface with compute. And that happened in the 80s with IBM and mainframes. It took IBM to be one of the world's largest companies. We moved to that client server model of computing. Microsoft created trillions of dollars of value, and mobile, and we had Apple, and internet, and I lump cloud infrastructure into that. You get Amazon, you get Facebook, you get TikTok. So I think it would be a very unusual transition in our compute model that it didn't create some new big companies. And that's what's really exciting for long-term growth investors in this.
And a few losers as well, potentially, because that's part of the lesson of the .com, isn't it? Was that there were lots of winners and quite a few losers at the same time.
Also some very substantial sized businesses that looked like they were going to run away with it, and in reality, had their sort of lunch eaten by others, and you look at where Nvidia's come from in a relatively short space of time, I guess, compared to some of its competitors, and the monopoly it has over that sector at the moment. I think it'd be very odd for it to have that same control over the market in 10 years' time as it does today. So it's what you said earlier, that you're sort of looking for the next magnificent seven in a way, as opposed to the existing, and that's what the trust tries to do.
Yeah, I think that's right. It's these big players are really interesting, but it's who are going to be the big players 10 years from now, being resolutely focused on the future. But I think the theme that for me links what both of you said is competitive advantage. You go back to that period in the late 90s, it looked like the internet had was going to democratize the economy. Anybody could open an online store, and nobody had an advantage anymore. Well, wind the clock forward, that wasn't true. The advantage did not fall equally, and Amazon has become a formidable company on the back of that. The same question, I think, in AI, for NVIDIA's, what they have created is a huge prize. They'll do more than $100 billion of revenue this year. They'll do it with eye-watering operating margins. So the whole of the rest of the industry wants a piece of that. That's capitalism in action.
Yeah. 100%.
And it's how enduring are the advantage that NVIDIA has. They were plugging away at this technology when nobody else was.
Of course.
They've got in the chip world, they've got a very long head start, but they've also got a software layer that sits around that compute infrastructure that is the default standard for the industry. And again, it's going to be hard work to get around that. And so, I think it's absolutely right that everybody's coming for that. And the key question is, how long does that edge endure?
Yeah, no, that will be interesting to see. I mean, you look at any business that's got a kind of 80% gross margin like NVIDIA has, and you think, well, that definitely can't last because someone else is going to come along and undercut them, because that's what happens in capitalism. So it's a case of, is their moat big enough to endure that, or is it going to be 50% margins, or is it going to be down to 30% margins at some point? We just don't know, I think. And certainly they've got themselves to the position where they are pretty dominant and pretty powerful, and the share price kind of speaks volumes for that.
And semiconductors, let's not forget, has always been a cyclical industry.
Yeah, definitely.
And I certainly wouldn't be in the camp of saying that's changed.
Yeah, no, definitely. Well, I think we'll sort of wrap it up, but just sort of thinking about it, Scottish Mortgage has been a kind of huge positive for the UK market, and it's been phenomenally successful, 20 bagger over 20 years, and of course a bit of volatility along the way. I mean, have you got any sort of broad views on the UK market? I mean, much as the UK market, the DRL FTSE is much maligned. A number of companies here is dwindling, no IPOs. Lots of companies either gone or going to the US and done very well out of the back of it. Have you got the Scottish Mortgage maybe suffer a little bit being listed in the UK market, or do you think that there's still plenty of opportunity here?
Well, I think the market the UK market is just a sort of barometer of health of what else is going on in the UK. Are new big businesses being founded and built in the UK? That I think that's the challenge for us. Do we, are we able to take the IP, the great IP that's been created in UK universities, and actually commercialize it successfully? Do we have sufficient ambition? And I think when you if you have those ingredients, you will see companies coming through to the stock market. Right. Just as one of our holdings, Wise, has done in the past few years in that money transfer area, where they have a genuinely different product, which is a great value for consumers and difficult for others to compete with. So, I think it's that engine of innovation that's really important.
Good. We'll leave it there. But thank you, Tom. Thank you, Claire, for your time this morning, and safe travels back north of the border. And thank you very much for watching and listening today. Any questions, then do get in touch. It's james.hughes@courtachievia.com, and I'm jonathan.raymond@courtachievia.com. And we'll see you next time. Thanks very much.
Thanks
for having us.